Hello friends, it's been over 2 years since I recorded a couple of videos in association with Equity Master on their channel because I was empaneled there as a consulting editor for commodities and currencies. Now, it's like I said, over 2.5 years ago. The crux of those videos was that there is money going to come into India via the bond market. Now, the bond market is something not too many people watch, and that is frankly a big mistake because these flows are bigger than equities and they can make a lot of difference. Now, my argument was, and the argument is still valid, that bond inflows come from long-term investors. These are not equity investors, which is hot money. They come in, they go out. When stocks are rising, everybody is happy. When stocks start falling, the FII starts selling. You would have seen that before the election results, how the FIIs were selling. Had it been bond market investors, which are typically pension funds, hedge funds, etc., they would not have panicked and they would have held on to their investments in the Indian government sovereign guaranteed bonds. Now that we've established that these inflows are stable, what are the repercussions of bond inflows? Number one, your rupee dollar peg, the currency peg, becomes stable. The less volatile a currency, the better it is. Now, can you imagine Bitcoin if it was to become a legal tender? Now it fluctuates 20% in a week sometimes. All right. Now imagine if your legal tender or your legal currency was to be up and down, up and down. Today you're a millionaire, tomorrow you're a billionaire, and possibly next month you're worth a few 100,000 only in overseas converted currency basis. We don't want a volatile currency. All right. So the bond market inflows will guarantee that our currency volatility goes down. Number two, since this is long-term money, bonds could be from anywhere starting from 3-year tenor to all the way up to 30, 40 or even 50-year tenor. All right. So this money can go to fund infrastructure, roadways, highways, ports, airports, railways, build better infrastructure to connect the country via telecom networks, satellite connectivity, etc. Everything that the real street, the real economy needs to progress. Now, will the stock market gain out of it? The answer is yes. If not directly, at least indirectly. Why not directly? Because the stock market tends to be a little more disconnected from reality as compared to the bond market. Do remember when COVID lockdowns were imposed in March 2020, factories were shut, offices were shut, stocks were flying up. And that pretty much continued for at least 18 months. So stock markets can be at divergence from the real economy, which is called counter-cyclicality. And when the stock market and the real economy are in sync together, it's called pro-cyclicality. There's a video coming on pro-cyclicality in the future. Please stand by for that. Now, so this long-term money that will come in will result in bigger factories, bigger infrastructure, ports, airports, railway lines, etc., generate employment, which again will have a trickle-down effect on the stock market, which will go up. So yes, it will go up. Now, what has changed in the last 30 months or so since I last made that video about the bond market being a funnel through which a lot of money will come into the Indian stock market? Let's take a look at what has really happened. Now, you see, in addition to the bond market, I had also advocated a couple of other aspects. There is this one video which is on my channel, and the Equity Master video that I have talked to you about is already there on their channel itself. You can go and check that playlist out. Now, the other thing that I had mentioned back then was SEPA. So that was a comprehensive economic treaty with the UAE, in addition to the free trade agreements which were being negotiated with countries like UK, Australia, etc. The third thing that I told you that would be a game changer was the municipal bond market. So state municipalities would come in and start accessing the bond market for funds for city building. Now, all these are in the pipeline. It's all happening here. All right. So put together, this should have a cumulative beneficial impact on our stock market over a period of time. And what has happened in the last 30 months or more since I last made those videos was that the Modi government has come to power for the third time. Now, is all hunky-dory? Is everyone, now that they are Johnny's come lately compared to when I was talking about the bond inflows, the retail direct GSEC scheme of the RBI for Indian bond investors, compared to those videos, everybody is a Johnny come lately. No offense meant here. But are these guys justified in being gung-ho and having joined the party late? I want to take a look at it with data. So now that the Modi government has come to power for the third time, number one, their strength in the parliament is slightly watered down. They have a coalition government, which means their say in the floor of the house is a little diluted. And what I anticipate is there is a possible probability, I'm using the word probability here, higher social welfare spending. In order to placate and please everyone, there could be a little bit of more money being passed around. For example, take a look at what's happening in Maharashtra. The scheme of giving 1,500 rupees to women between the age of 21 and 60 from below poverty line families is going to cost the national exchequer money. Now, when you're going to give social welfare money, somebody has to pay the bill. And either you start raising taxes or you borrow money from the bond market and use that for social welfare in anticipation of trickle-down benefits to the GDP. If at all the bond market senses that social welfare spending is going to go up and it is going to be funded from borrowing from the bond market, you are possibly likely to see bond yields go up, which means bond prices coming down, which is what has happened on the very first day as I record this video, when Indian bonds were listed in the global overseas indices. Indian bond yields have now crossed 7%. And this is at its highest after 11th of June 2024, which means bond prices have come down. If the bond markets are feeling that there will be higher borrowings from the bond market for social welfare or other means, does it mean that FIIs will hold back their checks? What else do they have to invest in? Where can they invest? Where will the money go if not in India? Now, this is a question that I will answer in this video. You see, in Asia, which of course is where interest rates are relatively higher, you have a couple of countries which are either matching our bond yields or even higher than India. So you have Bangladesh, very close to us, offering a little over 13%. You have Indonesia, which is offering 7.168% on their 10-year benchmark bond yield. You have Pakistan. Let's not even go there, but let's, for the sake of comparison, talk about numbers. You have 14.506% at the time of recording this video. You have Philippines, which is offering close to India, less maybe, but at 6.672%, it's in the reckoning. And then finally, in the region, you have Sri Lanka, which is offering 13.30%, which is higher than India. Now, first of all, why do people invest in bonds? It is because of the cash carry trade. You borrow money from a low interest bearing economy, take it from here, come to a country where interest rates are higher because you get to play on the differential. This is called the cash carry trade. So now you take money out of US or UK or Japan, borrow money from there, invest in India because you're getting 7%. The difference is your profit. Of course, there are round trip expenses of remittances, currency hedging, etc. So net, your yield might be a little less, but you're going to make a lot of money. Who invests in the cash carry trade? Two kinds of people. Number one, institutional investors, especially mutual funds, pension funds, maybe even government funds from overseas. And number two, hedge funds. Why hedge funds? Because hedge funds are highly leveraged entities. They can borrow up to 200% or 200 times rather of their assets, net owned assets, and leverage themselves and play on very small margins. Those of you in my online family have been with me long enough will remember how I used to point out to you that hedge funds were investing in the sovereign debt of Peru, economically and politically disrupted country where there's a lot of upheaval going on there since the last couple of years. But the reason why they were investing money in Peru, because they were getting a 3% differential or cash carry trade payoff. So now you're going to tell me, Vijay, why are you saying that in India there will be inflows in spite of the fact that Sri Lanka is offering 13.3% and Indonesia is offering 7.16% and Bangladesh is offering 13%? Why? Because what you are not calculating is another aspect. And here is that aspect. Take a look at how the currencies of these countries that are offering at par or higher than India rates. Bangladesh in the last 30 months or so has seen its taka, the local currency, depreciate by over 36%. Indonesia in the same period has seen its currency, the Indonesian rupiah, depreciate by a little under 12.5%. Pakistan, of course, 56% depreciation in the Pakistani rupee. Philippine peso has depreciated by 14.17%. And Sri Lanka, a whopping 50.4% depreciation in the Sri Lankan rupee. On the other hand, the Indian rupee has depreciated 9.30%. Now, why is this important? Why is the rupee versus the dollar important? Because assuming that you got in money in the cash carry trade funnel when the USD INR was 60 rupees, you invest money in India's bonds, and when the bond matures, you want to take that money back home to New York, and the USD INR is 90 bucks. So, when you got $1 here, it got you 60 bucks. But when you want to take that same dollar back, you need to pay 90 bucks to buy that $1, which means you're down 50%. Are you getting 50% yield in 10 years from the bond? Yes, but that shaves off your profit. So a stable currency is where money will go. Unfortunately for us, the Indian rupee is the most stable in the number of countries that I mentioned. To be precise, 5 nations that are offering matching or higher sovereign bond yields as compared to India. Which is why, yes, I think FII money will come in, but the one mistake that everybody is making is the mistake that everybody usually makes. They think that once you open the doors, money is going to come in all at one shot. Hey, that ain't happening. You know what? We've just opened a shop. You let the shop open, you're going to get buyers come in, they're going to sniff around, they're going to look in your showcases, they're going to touch and feel your products, they're going to see what you have to sell, they'll offer some counter kind of offers. Hey, give me 10% discount, give me 5% discount, can we negotiate, what if I put in a higher amount, can I get a better deal? It will take a little time. But yes, money will come. Will the stock market benefit? Yes, it will, directly or indirectly. Why? Because I just told you earlier, bond money is long-term money, stable money, employment generation, infrastructure generation, and basically quality of life goes up, GDP grows with a lag effect. So I think much will depend on this government's execution of these projects once the money comes in via the bond market. Am I optimistic? Yes, I'm optimistic. Now, the last time around when I made these videos about SEPA, about bond money leading to huge inflows in India, I even made a video then about how India would be able to get crude oil cheap on Equity Masters channel. And I got a lot of colorful abuses. Hey, are you a bloody Modi Bhakt or what? Now, a clarification here. I'm nobody's Bhakt. Not Modi, nor Rahul Gandhi, nor anyone else. If at all I'm a Bhakt, talking about inanimate objects, non-living objects, I'm a Bhakt of data. I worship data because I get food from data. Data gives me profits, and profits put food on the table for my family. As a group of people, I'm a Bhakt or a worshipper of my family. Everything I do for them. Optimism, yes. Is money going to come in? Yes. Is it going to come immediately? No, with a lag effect. And is there going to be 10, 20, 30, 40, 50 billion coming? I have no way of knowing. I can't read the FII minds. But my guess is they'll sniff around, they'll wait to see when they are investing money, where is that money getting deployed, which project is being made from what money, and then as and when they see results of that money being utilized in a productive channel, more and more money can come in. But like I said, it all depends on us, our government, as to how they execute. Overall, is it a good step? Fantastic step. I love bonds, and to be honest with you, I don't discuss markets with people who don't understand the bond markets. If you don't understand the concept of cost of money or cost of funds, I don't want to talk markets with you. All right. Is there a good place to learn about cost of money? Dick Stoken of my time was one of the best guys to learn about the concept of cost of funds. Till we meet again in my next, this is Vijay Bhambwani signing off for now, not before reminding you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know what you think of my work, how it helps you become a better trader and investor, and what would you like me to record in the future so it helps you improve your journey in the financial markets. And more importantly, please help me to reach out to a wider audience of smart traders like yourselves by sharing my video with your friends, your family, your social media groups, etc., so I can help more and more people take informed decisions. I and my company do not offer any paid services whatsoever. This is our labor of love. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable day ahead. Bye-bye.